A historic day. UK citizens voting to leave the European Union. Global stocks are tumbling. The pound sinking to its lowest level against the dollar in 31 years. And UK Prime Minister David Cameron is stepping down. For reaction, I'm joined now by Michael Ingram, a market analyst at BGC Partners in London. And John Canali is the Chief Economic Strategist at LPL Financial in Boston. And gentlemen, it's great to have you here on this incredible day. Michael, you're in London. I want to start with you. The pound is now 6% lower against the dollar to about 136. Are the declines over?
Yeah, I'm just amazed how we sort of, slammed our faces into yet another financial crisis. I mean, you look at market price action yesterday, you wouldn't have thought that the polls were even remotely close. They were really following the bookmakers. And of course, at 2 o'clock London time this morning, sterling fell off a cliff. It has recovered somewhat since then, but obviously, markets right now are sea red. Having said that, interesting to note that the euro is also down. European peripheral bonds are also under pressure, and euro stocks are looking at even worse than the FTSE 100. So the idea that Europe can actually survive a Brexit and walk away unscathed, I think there's a big question mark over that.
Well, Michael, we're also seeing the safe haven pile-on. We have bond yields, down. We have the yen rallying. So what's your advice to investors right now?
Well, of course, I mean, we've seen policymakers in Japan agitating for some time. It's been a massive pain trade for the Japanese economy over recent months. In the most recent G7, we saw Japan agitating for the leaders to declare a crisis and give them cover for further monetary easing and currency devaluation. They didn't get that. Well, maybe they'll get a more sympathetic hearing this time around. The problem is, of course, is that the amount of monetary ammunition in the arsenal is relatively limited.
Yeah.
And, we are in many ways in uncharted territory.
John, let me bring you into the conversation. Let's talk about the U.S. impact from all of this. This has to take a July rate hike off the table, even if next Friday's jobs report showed we created 500,000 jobs in June.
I think it might take a July 2017 rate hike off the table, maybe July 2018. But no, we've certainly seen some pull through here to the U.S. I think the biggest risk to the U.S. economy is the tightening up of financial conditions based on a stronger dollar. That's probably the biggest immediate hit. We're still going to export things to the UK. We're still going to export things to the Eurozone. I think the situation now is that markets are going to go from figuring out who won the Brexit vote to figuring out how the divorce is going to be negotiated between the UK and the EU. That's going to be very important. Is it quick? Does it take 2 or 3 years? Is it messy? And then the other wild card here is what happens with EM currencies and especially China. How China reacts to this could be very important in the coming weeks and months.
Well, John, that's a great point, and I want to go to Michael in terms of what global central banks are going to do to help. Michael, talk about the £250 billion that the Bank of England is making available.
Well, yes, I mean, Bank of England sought to calm markets early this morning, very detailed communique from them, and I thought it certainly has contributed to settling markets down. Unlike George Osborne, who said he didn't have a plan B, it does seem that at least the monetary authorities here have had a plan B, and of course they laid that groundwork out over a period of months. What, of course, we may be looking at in the days ahead is more coordinated action on behalf of monetary authorities. I have to point out, however, that over-reliance on monetary policy over the years post-crisis, I think, is part of the problem, and I don't think it's part of a durable solution. So politicians have to get re-engaged, but of course they've just been delivered a massive shock, and it might be very difficult to get them on the same page anytime soon.
Well, part of the problem, because central banks are so overextended with lifting growth, that now they're now forced to react to this problem. Michael, is this a Lehman type event for the markets in your view?
It's certainly not on that scale at the moment, and I think that one of the things that the policymakers have actually done right over recent years is make financial institutions and the whole financial infrastructure and global economy rather more resilient. Having said that, I think that we what we have been seeing is this slow drip of bad news, you know, low productivity growth, low growth, etc., and that is having a caustic effect on the global economy. It's having social and economic implications, and we're seeing that very signally in this Brexit vote, and we're not alone. I mean, just this weekend we're seeing a Spanish vote. How's that going to go? Maybe that's the reason why we're not hearing much from Brussels at the moment, because I'm not sure what they could say which is actually going to help their position right now.
John, do you agree? Is this a Lehman-type moment for the markets?
It's probably not, and I think policymakers, central bankers, fiscal authorities as well are benefiting from having gone through the Lehman crisis just less than a decade ago, so they're better able to respond. I think it's fortunate that yesterday the Fed released the bank stress test. All 33 banks passed. The U.S. banking system is in very good shape relative to where it was certainly in 2008. And I do agree on the fiscal side. The problems that we're encountering here cannot be totally fixed by monetary policy. They have to have some fiscal stimulus. Hopefully, countries and governments can agree to do some of that in the coming months and quarters and years.
And Michael, just very quickly, European banks getting slammed. We've got Lloyd's, HSBC, Barclays all down. Do you see a buying opportunity here with some of these stocks?
I suspect there's a trade, and after all, you know, at the UK Open, we saw some of the more domestically oriented banks listed, such as Lloyd's, RBS, Barclays, down by 30+%. They've already started to recover. If you could have traded around that, obviously that looked like it was overrated. Having said that, you know, it's going to be a long haul. I'm really just waiting to see what the vibe from Brussels is. Is it going to be, you voted that way, you can just all go to hell? Or is it, you know what, we respect the vote and let's work something out? So we've made our decision. Now the ball is in Brussels court, I think, at this point.
John, I'll give you the last word. We got about 20 seconds left.
Well, listen, I think the key for investors of all stripes is just to remain calm here, look at your long-term goals, don't make any rash decisions today or over the weekend or next week. See how things unfold and just keep your long-term goals in mind and things should be okay.
All right, well, it's certainly an incredible day, and we're looking at, you know, a global sell-off here. Michael Ingram from BGC Partners in London and John Canale from LPL Financial. Gentlemen, it's great to have you here. Thanks for joining us.
Thank you.
My pleasure.
I'm Scott Gamm, and you're watching The Street.